flashcards so I can listen to these later when I'm in the car. Estate planning, non community property interest, income earned by spouse prior to marriage, property gift, property received as a gift by one spouse, property inherited by one spouse, interest earned on separate assets held by one spouse as sole owner, joint tenancy with rights of survivorship. Property can be held by husband and wife, parent and child, or children, siblings, and business partners. Control, ownership, and enjoyment shared equally by all joint tenants. Upon death, each tenant property immediately passes to surviving joint tenants in equal shares. Property not controlled by terms of the will not be subject to probate. Tenancy by entirety. Ownership can only be held by a husband and wife. Transfer of property can occur with the mutual consent of both parties. Most states, property is protected from the claims of each spouse's separate creditors, but not protected from the claims of both spouses' joint creditors. That is tenancy by entirety. Tenancy in common. Tenancy in common. Two or more owners each own an undivided interest in the property. Any income is distributed according to each owner's respective share in the property. Owners are free to transfer their respective share of the property to other individuals. Ownership stake goes through probate upon death. That is tenancy in common. Assets that are not subject to probate are property conveyed by the deeds of title, IRA, property held by joint tenancy with rights of survivorship, government savings bonds, co-ownership, revocable living trusts, payable on death accounts, PODs, and Totten trusts that are assets that are not subject to probate. Assets that are subject to probate are singly owned assets, prospect held in tenancy in common, assets where the beneficiary is the estate of insured community property. That is assets subject to probate. Singly owned assets, property held in tenancy in common, assets where the beneficiary is the estate. Assets included in the gross estate. Singly owned assets, tenancy in common. Beneficiary is the estate. Community property, JTWROS entirety. Life insurance, general powers, 3-year gross up on gift taxes paid, but not GST taxes paid. That is assets included in the gross estate. Life insurance added to the estate. Proceeds are paid to the executor of the descendant's estate. Descendant at death possesses an incident of ownership in the policy. Descendant transferred a policy with an incident of the ownership within 3 years of death. That is life insurance added to the estate. Valuation of a gift. The value of a gift for tax purposes is its fair market value at the date of the gift. Basis of a gift. If fair market value of the gift is greater than the donor's adjusted basis, use the donor's adjusted basis. If the fair market value is less than the donor's adjusted basis, use the chart below. Chart below, donor's substituted basis. Here's the chart. Is that going to focus? If the sale above substituted basis, there is a gain. If the sale is in the range, there is no loss. If the sale below fair market value, there is a loss. Examples: if the price is 75,000, gain is 25,000. Yeah. Deductible gifts, not taxable gifts, also called exempt gifts or qualified transfer. Gifts to a spouse, provided they are not terminal interest. Gifts to qualified charities, qualified payments in any amount made directly to an educational institution or tuition. Qualified payments in any amount made directly to a Medicare provider on behalf of any individual. Gifts to American political parties. Summary of rules regarding gifts and donor estate. Generally, gifts are simply taxable gifts to the extent such gifts exceed the annual exclusion. Taxable gifts are added to the taxable estate. Gift taxes paid or payable are generally allowed as credit against tentative tax. Gift taxes paid on any gifts within 3 years of death are added to the gross estate. Powers of attorney. Traditional non-durable power of attorney. Power ceases when the participant is no longer legally competent. Durable power of attorney. Authority of agent continues when principal becomes incompetent. Springing durable power of attorney. Main strength is the agent has no authority over the principal's asset until incompetency. Powers of appointment. Trusts. Special power, exercisable only with the consent of the creator of the power or a person having substantial adverse interest. Ascertainable standard relating to health, education, maintenance, or support. HEMS. General power. Holder may exercise the power in any manner as she wishes. He or she wishes. That was powers of appointment. Gift and estate tax implications. General power. Gift tax implications. General power. Exercised, released, or lapsed, taxed. Lapsed with a 5 or 5 power, not taxed. Estate tax implications. General power. Exercised, released, or lapsed, it's taxed. Exercised, released, or lapsed with a 5 or 5 power greater of the 5 or 5 is taxed. 5 or 5 power. Property subject to a general power will be included in a donee's descendant's estate or considered a taxable gift, only to the extent that the property exceeds the greater of $5,000 or 5% of the total value of the fund subject to the power as measured at the time of the lapse. Grantor trust rules. Tainted, defective trusts, income tax, and estate. Trust may be defective, tainted, or for income tax estate purposes if the grantor retains a right to income or the right to use and enjoy the property beneficial enjoyment. A revisionary interest exceeding 5%. Elements of a trust. In order for a trust to exist, there must be property, also known as principal or corpus. There must be a grantor. This is any person who transfers property to and dictates the term of a trust. There must be a trustee who receives legal title to the property placed in the trust, who generally manages and distributes income according to the terms of formal written agreement, trust instrument. There must be beneficiary who has equitable title to the property. The grantor and trustee must be legally competent. Simple and complex trusts. Simple trust 2503B, marital, and Q-tip are considered merely a conduit for forwarding income to beneficiaries, also known as a pass-through. Complex trusts 2503C are separate tax entities and taxed as such. If it meets 2 requirements, it is irrevocable and the grantor has not retained any control, and income is accumulated. That is simple versus complex trust. Crummy trust. Irrevocable trust with demand rights. Demand right given to a minor through his or her guardian. Beneficiary has the temporary right to demand or withdraw from the trust that is lesser than the amount of the annual gift exclusion or the value of the gift transfer. Non-meritable B trust, family bypass, credit shelter, unified credit shelter. Property transferred to the trust at the time of the descendant's death can be structured to provide a stream of income surviving spouse or other individuals. Descendant has post-mortem control. Q-tip. C trust, current income trust. Provides surviving spouse with a stream of income for life, but descendant has post-mortem control of the trust property. Property qualifies for marital deduction, mainly used for second marriages. Keyword for Q-tip is lame. Lifetime income for the spouse, annual payments to the spouse, mandatory payments to the spouse, and exclusivity for the spouse. Qualified domestic trust, QDT or Q dot. No unlimited marital deduction. However, no estate tax due. Jointly held property between the spouses are not considered one half owned. Limited gift between spouses are only $100K indexed per year. Present interest gift vehicles. UGMA, UTMA, 2503C trust, and Section 529 college savings plans. Gift to a 2503B trust is a gift to a future interest, not a present interest. So present interest is UGMA, UTMA, 2503C trust, and a Section 529 savings plan. Charitable contributions, transfers. Income to donor until donor's death. Charitable remainder annuity trust, CRAT, 5%. Charitable remainder unitrust, a CRUT, is 5%. Pooled income fund, no 5% required. Charitable gift annuity, no 5% required. Income to charity, charitable lead trust, CLAT and a CLUT, no 5% required. Private foundation, 5% can give money to individuals. Intra-family transfers, property owners need income. Pigs need income. Private annuity, installment sale, grantor annuity trust, GRAT or GRUT, self-canceling installment note, a SKIN. Pigs need income. That is intra-family transfers. Property owner needs income. Pigs. Intra-family transfers. Property owner wants to gift assets or income to family members. Partnership or escort. Family limited partnership. Gift lease SPAC or qualified personal resident trust, QPER. Disclaimer. In order to disclaim property, the following requirements must be met. Disclaimer must be an irrevocable refusal to accept the interest. Refusal must be in writing. Refusal must be received within 9 months. Intended donee cannot have accepted any interest in the benefits. As a result of the refusal, the interest will pass without the disclaiming person's direction to someone else. Post-mortem planning techniques, estate liquidity. Stock redemption, Section 303. Businesses must be incorporated, closely held. Value of business must exceed 35% of the descendant's adjusted gross estate. Redemption cannot be the sum of the estate plus administration expenses. Installment payment of the estate taxes, Section 6166. Value of the business must exceed 35% of the descendant's adjusted gross estate. During the 4 years of 14 years, can pay interest only on taxes due. Post-mortem planning techniques, estate tax reduction. Special use valuation, section 2032A. 25% of the gross estate consists of real property, must be in qualified use, 5 out of 8 year rule before death and 10 years after death. That is the estate planning cards. Now we're going to move on to insurance planning. No, we'll do investment because there's less than investment. Oh, wait, that's wrong. Let's go with that. I'm going to do these investment ones. Unsystematic risk, known as diversifiable risk, may also be referred to in some reference books as non-systematic risk. Business risk refers to the nature of the firm's operation, i.e., possibility of loss due to new technology. Financial risk refers to how the firm finances its assets, i.e., possibility of loss due to heavy debt financing. Systematic risk, known as non-diversifiable risk, the part of the risk is inescapable because no matter how well an investor diversifies the risk of the overall market, cannot be avoided. Types of systematic risk. Prime stakes. Systematic risk. These are types. Purchasing power risk, loss of purchasing power through inflation. Reinvestment rate risk, risk that proceeds available for reinvestment must be reinvested at a lower rate than the investment instrument that generated the proceeds. Interest rate risk, risk that the change in interest rates will cause the market value of all fixed income security to fall. Market risk, risk of the overall market. Exchange rate risk, risk associated with the changes in the value of currency. FDIC insured amounts per bank per type of account. Individual 250, joint 250, trust 250, IRA KEO 250. The yield ladder. Discounted bonds, yields higher than coupon, yield to call, yield to maturity, current yield, nominal yield, annual coupon rate, current yield, yield to maturity, yield to maturity yield, to call, yields lower than coupon premium bonds. That's the ladder. Double E bonds, EE bonds. Non-marketable, non-transferable, cannot be used for collateral. Sold at face value. Interest rate based on the 10-year treasury notes. Note yields. Fixed interest rate that is in effect at the time of the purchase, subject to federal taxation when redeemed unless used as educational bonds. Not subject to state or local taxes. That is double E bonds. I bonds. Non-marketable, non-transferable, cannot be used as collateral. Sold at face value. Interest rate is composed of two parts. A fixed base rate remains the same for the life of the bond, and inflation adjustment adjusted every 6 months. Subject to federal taxation when redeemed unless used as educational bonds. Not subject to state or local taxes. Types of municipal securities. General obligation bonds, backed by the full faith and credit of the taxing power of the issuer. Go bonds are generally considered the safest type of municipal credit, general obligation bonds. Revenue bonds, backed by the specific source of revenue to the full faith of the credit of the issuer, is not pledged. Because revenue bonds are backed by a single source of funds, like toll roads, hospitals, nuclear power plants, they have greater risk than go bonds. As such, they trade at higher yields. Issuer municipal bonds. The issuers pay timely interest and principal when the issuer is in default. Municipal bond insurers are AMBAC, American Municipal Bond Assurance Corporation, and MBIA, Municipal Bond Insurance Association. That was the types of municipal securities. Indenture agreement covers form of a bond, amount of issue, property pledged, protective covenant, including any provision for a sinking fund, working capital and current ratio, redemption rights, call but no conversion provisions. Corporate and municipal bonds. DRIP. Default risk. A creditor may seize the collateral and sell it to recoup the principal. Reinvestment risk. As payments are received from an investment, interest rates fall. When the funds are reinvested, the investor receives a lower yield. Interest rate risk. Rising interest may cause bond prices to fall. Purchasing power risk. Inflation may lower the value of bond interest payments and principal repayment, thereby forcing prices to fall. That is corporate and municipal bonds, DRIP. Government bonds. RIP, there's no default or credit risk. So it's the same as DRIP, but there's no D, so there's no default risk. Capitalization market of company. Large, market value exceeds 10 billion. Mid, market value is between 2 to 10 billion. Small, market value is less than 2 billion. Micro, market value is less than 300 million. That is capitalization of market of company. American Depository Receipts, ADR. Prices of ADRs quoted in US dollars. Dividends paid in US dollars. Dividends declared in foreign currency. Attained diversification and risk reduction due to lower correlation of foreign securities with US securities. American Depository Receipts. Real estate, lands improved, NOI. Improved land is normally income producing. Income properties include residential, rental, commercial, and industrial properties. The intrinsic value of real estate property can be computed using a net operating income, NOI computation, which is gross rental receipts plus non-rental income, laundry, etc., over potential gross income minus vacancy collection losses minus operating expenses included, excludes interest and depreciation, equals net operating income. That's the equation. I don't think it's over. It's just minus. Options. General definitions. Intrinsic value is the minimum price the option will command as an option. It is the difference between the market price and the exercise price of the stock. Exercise price, strike price, is the price at which the stock can be purchased or sold on exercise of the option. Premium is the market price of an option. As the option approaches its expiration date, the market price of the option, the premium, approaches the intrinsic value. Time premium is the amount the market price of an option exceeds its intrinsic value. IV plus TV equals premium. Call options. Taxability. At the time of purchase, non-deductible capital expenditure. To the writer due to lapse, the premium is paid in short-term gain. To the writer due to the exercise, premium is paid, is added to the sale price, can be long-term if the underlying security was held for more than 12 months. Otherwise, it is just short-term gain, covered call. To to the holder, if the option is not exercised, then the option is considered sold. It expires and it is a short-term loss. The option period is 9 months or less. Hedging strategies, straddles and combinations, caller, protective, and put. Straddle, buying a put and buying a call. The buyer does not own the stock. Caller, sells a call out of the money at one strike price and buys a put at a lower strike price. Investor owns the stock. Protective put, buying a stock or owning it already and putting and a put for the stock serving as insurance against the decline of the underlying stock. Good answer for the exam. Warrants versus call options. Warrants are issued by corporations, whereas calls are created by individuals. Warrants typically have maturities of several years. Warrants are not standardized. Call options are standardized. Futures contracts. Long commodity position is a farmer is a long commodity, for example, corn. He needs a short hedge and will sell a futures contract. Short commodity position. If Kellogg's is a short commodity, for example, corn, Kellogg's needs a long hedge and will buy a futures contract. Homeowners forms of coverage. You've got HO1, which is basic on A, B, C, and D. HO2, which is broad on A, B, C, D. HO3, open coverage on A, which is your dwelling. 10% open on B, which is your structures. On contents, it's broad, 50% A. And then on D, it's open, 30% of A on loss of use. HO3, same thing. HO8 is for older homes. HO4 is for renters. HO6 is for condo owners. HO3 is the best. There is HO5, I guess, is the same as HO3 on here. Can have coverage, blah, blah, blah. Policy lists perils. Basic plus RAF. Ruptures of a system, artificially generated electricity, falling objects, freezing of plumbing. Perils. Oh, that's perils broad form. Insurance rated service category. Most comprehensive service. AM, best. A++ to F. Standard & Poor's, AAA to CCC. Section of homeowners policy. Section 1, coverage A, B, C, D. A is dwelling and attached structures. B, structures separated from dwelling and attached. We're on insurance now. Structures separated from dwelling and detached garage fences, contents, and personal property. D, loss of use. Section 2, coverage E and F. E is liability. F is medical payments. F is first aid. E is enemies. Property excluded under personal property coverage. Animals, birds, and fish. Motorized land vehicles and aircrafts. Property of roomers, boarders, and other tenants. Property contained in an apartment regularly rented for rental and others by insured unless formally endorsed. Perils covered basic form. The policy lists perils covered wharves / FLT, wind, hail, aircraft, riot, vandalism, vehicles, explosion, smoke, fire, lightning, theft. Calculating life insurance needs. 2 methods. Capital utilization approach uses annuitization to provide needed income but leaves no money at the end of the planned period. Capital needs approach uses interest only, so the original capital is still left at the end of the income period, also called capital retention or interest only. Defenses. Assumption of risk. Skiing, stock car racing, skydiving. Contributory, jaywalking, being drunk. Comparative, A is 20% negligent, B is 80%. Last clear chance, road rage. You had an option to, avoid, but you didn't. Negligences, attractive nuisances, swimming pools, vacant lot. Negligence per se, violate a statute. Strict liability, product liability, absolute liability, workers' compensation, vicarious liability, respondent superior, principals responsible for their agents. That's negligence. Parts of the insurance contract. You have the declarations page. It's a factual statement that identifies the specific person, property, or activity being insured. Definitions, explanation of key policy terms. Insuring agreements spells out the basic promise of the insurance company. Conditions spells out the details, the duties and the rights for both parties. Exclusions, circumstances when the insurer will not pay. Remember, DICE, parts of the insurance contract. DICE, declarations, definitions, insuring agreements, conditions, exclusions. Insurable interest. Property. Is this the microphone? Property casualty at an inception at the time of the insurable interest. Property and casualty at inception and at the time of the claim. Life at inception but need not at the time of the claim. Homeowner policy exclusions. Earthquake, flood, neglect, intentional loss, ordinance/law, power failure, war, nuclear hazard, sinkhole is a covered peril for the exam. Replacement cost coverage. Replacement cost times coinsurance percentage equals insurance required. Insurance carried divided by insurance required times the loss minus the deductible equals the amount paid by the insurance. Automobile risk exposures. Requirements for a vehicle to be eligible for Insurance Services Office, ISO, personal auto policy, PAP. Be owned by an individual or by a husband and wife, living in the same household. They have to be living in the same household. Be a private passenger automobile, not be used as a public or livery conveyance, not be rented to others. Auto insurance policy parts. Part A, limited to third parties. Part B, medical payments. Part C, uninsured motorists. Part D, damage to the covered auto. D for damage. Covered auto as used under the policy. Any vehicle shown under the declarations page, any of the following vehicles which you acquire during the policy period: private passenger auto, pickup truck, panel truck, or van. No coverage for a pickup, panel, or van used in business. You need a commercial policy for that. Any trailer you own listed in the on the declarations page, any auto or trailer you do not own while used as temporary substitute for any vehicle described in this definition, which is out of the normal use because of a breakdown, repair, servicing, or loss of destruction. That is covered auto used under the policy. Persons insured under the medical payments coverage of the PAP. The named insured and any family member who suffers bodily injury caused by the accident while occupying the covered vehicle. The named insured and the family members who, if while a pedestrian are struck by a motor vehicle designed for use on public roads or by a trailer. Other persons while occupant of the insured auto passengers. Uninsured motorist coverage. The agreement promises to pay the amount an insured could have collected from the uninsured driver if such driver carried auto liability insurance. The term covered person, as used under the uninsured motorist coverage of the personal auto policy, includes the following: the named insured and any family member, any other person occupying the insured covered auto, any person for damages that person is entitled to recover because of the injury to a person described not above. Special note: UN is a liability protection, not medical payments. Perils covered under other than collision provision of the auto policy. Breakage of glass, loss caused by falling objects, fire, theft, explosion, earthquake, windstorm, hail, water, flood, riot, or civil commotion, contact with birds or animals. Umbrella liability insurance, nearly always a correct answer since it is smart coverage. Provides liability coverage BIPD for catastrophic legal claims, requires policy owner to carry certain underlying coverage for specified minimum amounts. Professional acts are specifically excluded. Professional liability, malpractice, bodily injuries, doctors and dentists. Errors and omissions, E&O, monetary damages. This would be for financial advisors, lawyers, accountants, and insurance agents. Workers' comp, unlimited medical expenses, disability income tax-free, death benefits, rehab, medical and vocational, absolute liability. Medicare does not cover routine foot care, glasses, hearing aids, and dental work. Emergency care outside the U.S., some exceptions for Canada, Mexico, and the Caribbean. Medicare long-term care, benefits are limited, pays all of the first 20 days of skilled care, and everything over a specified amount per day for the next 80 days of skilled care, maximum 100 days. This limited benefit is subject to substantial restrictions, pays for skilled care only. Admission to a nursing home must follow within 30 days of a hospital stay of 3 days or more. The patient's condition must be expected to improve. HMO versus PPO. HMO, provider paid monthly fees regardless of service rendered capitation. Out of work Out-of-network care not covered at all. PPO, provider paid for actual services rendered. Out-of-network partially covered, usually 70%. COBRA coverage requirements. Must have 20 full part-time employees. The option to buy continuation. Coverage must be offered to terminated employees, dependents, continuation period up to 18 months, spouses and other dependents, continuation period up to 36 months. Voluntary and involuntary termination change from full-time to part-time. That's the 18 months. Continuation period is 18 months. Employee's death, divorce, or legal separation for Medicare. Spouses and other dependents have 36 months. Loss of dependent status, marriage, reaching dependency age limit specified by plan. Children's of employees, continuation period up to 36 months. Not the spouse, just children from a divorce. Health savings account. Used in conjunction with a high deductible health plan, HDHP. Distributions tax-free if used for healthcare. Contributions not spent are carried forward in the owner's name and are not portable. Unused assets become property of named beneficiary upon death. Distributions for non-medical are ordinary income, taxable plus 20% penalty if under 65. HSA accounts. Definition of disability. Own OC, best defined for insured. Modified, any OC. Split definition, own, then modified. Any OC, Social Security definition, loss of income. Definitions of disability. Disability income, policy continuation programs. Provisions, not programs. Non-cancelable, non-can, continuous term policy guaranteeing the insured's right to maintain the policy at the stated premium. Guaranteed renewable, continuous right to remain in the policy, but the insurer may increase the premium by class of insureds. Taxation of disability policies. Taxation of premium and benefits. The individual owns the contract and pays the premium. Premiums are not deductible. Benefits are tax-free to the employee. You're slugged, then you're hugged. Employee owns the contract and employee pays the entire premium under the bonus arrangement like Section 162 premiums. Insurance premiums are deductible by the employer as a bonus. Benefits are tax-free to the employee. Employee owns the contract. The employer pays the entire premium under a salary continuation plan, group plan. Premiums are deductible by the employee. Benefits are taxable to the employee. That's a hug, then slug. Permanent life insurance, low risk tolerance. Insurance company controls investment return, assets part of general account, whole life, universal life. Permanent life insurance, high risk tolerant. Client controls investment return, assets part of separate account, variable life, variable universal life. Permanent life insurance, high risk tolerant. Dividend options. Cash, reduced premium, accumulate with interest, paid up additions, 1 year term, 5th dividend. Acronym is CRAPO. Cash, reduced premium, accumulate with interest, paid up additions, 1 year term, 5th dividend. Dividend options, CRAPO. Non-forfeiture options. Cash, extended term, paid up, reduced amount. Settlement options. Cash, pure life, single life, refund, period certain, specified income, period, interest only. Modified endowment contract. Entered into after June 21st, 1988. Fails to meet the 7-pay test for exams include all single premium policies. Distributions, withdrawals are taxed LIFO, interest first. Distributions under 59.5 also have a 10% federal tax penalty if not disabled. Death benefit is tax-free. MEC, grandfather, life insurance rules. If the death benefit increases by $150K or less, and the insured has guaranteed insurability, no proof of insurability, the policy will not lose its grandfather non-MEC status. If the policy increases by any amount and the insured must prove insurability, the policy may lose its grandfathered non-MEC status. Proceeds taxable due to transfer for value. If an interest in the life insurance policy is transferred for value, consideration, not a gift, the proceeds in excess for the consideration paid for the policy combined with any premiums paid by the owner are taxable as ordinary income like a viatical. The three main exceptions to this rule are follows: a sale or transfer to the insured, a sale or transfer to a partner or partnership with is the insured partner, a corporation which the insured is a shareholder or officer, or a divorce. Proceeds taxable due to transfer of value. 1035 tax-free exchange rules. Life to life, okay. Life to annuity, okay. Annuity to annuity, okay. Annuity to life, no. Lindsay Lohan went to LA for AA, but not Alabama. That's the thing we use. Buy, sell, stock redemption versus cross purchase. Stock redemption, no step up in cost basis. Entity is owner and beneficiary. Cross purchase, step up in basis. Individual owner is owner and beneficiary. So stock redemption, no step up. Cross purchase, step up. Split dollar insurance, endorsement method versus collateral assignment method. Endorsement method, employer is the owner, employee is not a shareholder. Collateral assignment method, employee is an owner, employee is a shareholder, employee assigns the policy. Annuity taxation. Periodic payouts, basis over payout equals tax-free. Lump sum payouts, LIFO, interest first rule, ordinary income plus 10% penalty under 59.5. Flexible spending account. Must be used by March 15th or forfeited to company. Use it or lose it, medical only. Dependent care must be used by 12/31, December 31st. Not subject to income tax, FICA and FUTA. Health FSA may not be used to reimburse an employee premium paid for other health plans, such as MSA, HSA, or LTC. Expenses for long-term care services cannot be reimbursed under a health FSA, but other medical expenses can be reimbursed. Fringe benefits, tax-free major ones. Healthcare premiums, insurance premiums, or non-discriminatory group life, policy up to $50,000, company car for working conditions, employer provided transit passes, $315 month, or parking $315 per month cap, occasional overtime meal, cab fare, theater, sporting event tickets, discounts on services, limited 20% charged to customers. I hope that's not the microphone. Fringe benefits taxable. Health insurance premiums are paid for self-employed partnerships and more than 2% owners of S Corp are taxable in income. 100% is deductible. 1040. This can include all types of health insurance programs. Insurance 5%. Again, I'm using the right microphone.
I'm going to take a quick break and then I'll come back. That was